But look, we really should start the show with the big pieces of news that will shape the economic conversation in the weeks and months ahead. There's the US inflation rate, 9.1%, the highest in 40 years. Now, the problem seems to be that inflation's becoming sticky and that central banks have little choice but to raise interest rates even higher, even if it hurts their economies. Here's the acting employment minister, though, Mark Butler, talking this week about the good news, bad news dilemma of having such a low unemployment rate here in Australia.
Improvingly, the participation rate, the number of Australians who are actively in work, looking for work, is at record highs, including, again, female participation rates. And the youth unemployment rate is at its lowest level, down almost 1 full percentage point, at the lowest level since before the global financial crisis. This is all terrific news for tens and tens of thousands of Australians who today find themselves in work who weren't just last month. But it also reinforces the incredible tightness of Australia's labour market and the need for government to work collaboratively with business and with unions to boost productivity, to boost skills and training, and to boost wages and job security so that workers also see a dividend from this very, very strong labour market.
Well, late this week, all the talk has been about rates rising even faster than previously expected. New Zealand this week raised its cash rate 0.5% to 2.5%. South Korea by an unprecedented 0.5% to 2.25%. And the Bank of Canada raised its rate a full 1% to 2.5%. And there's a push for the United States rates to rise 0.75% or even 1 full percent at its next meeting. Here, the cash rate is 1.35%. But this week's 48-year low unemployment rate of 3.5%, while good news that people have jobs, is a warning sign of potential rising wages inflation and therefore higher interest rates. So let's bring in here Phil O'Donoghue, Chief Economist with Deutsche Bank in Australia. Phil, always good to chat to you about this. That's the dilemma. The warning signs are there, flashing amber at the Reserve Bank, at the government, at the economy. Somebody's got to do something about it.
Yeah, look, that's exactly right, Ross. I think looking at that international evidence that you just went through, it's pretty clear where interest rates need to go here in Australia. My sense is the RBA should be moving more quickly, more abruptly, get cash rate closer to neutral, potentially in contractionary territory.
OK, so therefore the next meeting, which is going to be the August meeting, it's just a little over 2 weeks' time. What should the Reserve Bank be doing?
That's right, Ross. In 2 weeks in August, look, I think we should be getting a 75 basis point increase in our cash rate. We're going to get a Q2 CPI number just before that meeting. Early estimates are that's going to be a very, very strong print. I think a 75 basis point increase will give the RBA an opportunity to express an intolerance for such strong inflation, send a message to price and wage setters that, you know, we need to get inflation lower than where it is, and aggressive rate hikes are the best way to do it. OK, so the Reserve Bank, and we've certainly criticised the Reserve Bank for this, seems to have been behind the curve through this whole cycle. Now, it's been waiting for empirical evidence, the hard evidence that things are happening in our economy. And if you look at it right now, there is no outbreak of wages inflation. It actually is in a pretty sweet spot, notwithstanding the fall in the unemployment rate to 3.5%. So why has the Reserve Bank necessarily got itself into this bind? One of the troubles I think that the Reserve Bank of Australia has is that we're relying on quarterly data. You know, the last time we had updates on prices and wages in Australia was for Q1. That data came in late April, in mid-May, for a point in time that was centred on Valentine's Day. Yes. Pre-Ukraine, pre the electricity and gas shocks we've seen here in Australia and the food price shock. So we've, you know, the RBA, you're entirely right, the RBA needs to wait and see that data confirmation, but we can look around the world, we can see where it's going. Pretty clear that we're going to be looking at some very strong outcomes for prices and, I think, wages in the second half of this year. OK, so the hard evidence that we got this week was the unemployment rate at 3.5%. That was a bit of something that you could actually hang your hat on and say, well, there it is. There is obviously this 500,000 job vacancies out there. There's around about the same number of people who are unemployed in Australia right now. Pre the pandemic, there were 3 times as many people unemployed for the job vacancies that were out there. That shows how that labour market has tightened. That's exactly right. The last time the unemployment rate was lower than it is now was 1974. Yeah. This is an incredibly strong labour market. You know, every textbook you look at tells you that one thing is going to happen is that wages are going to increase. That really reinforces the price and wage dynamics that the RBA is going to be facing. And, you know, they're going to need to get interest rates higher more quickly to deal with that.
And it is also staggering because you look back during the early stages of the pandemic, people really thought the unemployment rate was going to double digits. It peaked out around 7.5%, and to see it have fallen down to 3.5%, that as much as anything else is about locked borders, about the fact we didn't get migrants coming into this country, and as a result, the demand as our economy really heated up was for labour, and business can't find the labour right now.
Yeah, look, that's exactly right. To be fair, we have seen an excellent response from effectively adults. We've seen here in Australia those local adults that can work coming into the labour market. We've got a labour force participation rate higher than we've ever seen in Australia. So we've had a good supply response domestically, but you're entirely right. We're still losing, we're still missing that migration, particularly in lower skilled jobs, which has been such a crucial part of the economy pre-COVID.
OK, so then go further forward, because if we go and have a look at some of this labour force data, you talk about that participation rate there, record numbers of women in our workforce. And I mean, that's one of the big keys of the government with its Job Summit, is all about childcare. It's all about getting more women into the workforce, but it's also about skills. But it's actually a problem if there's a big demand for labour, but you simply don't have enough people in the country. That's where the migration debate comes into it.
Yeah, look, that's right. And you're certainly hearing the business community calling out for an increase in migration to fill some of those skills gaps. Like everything, there is a balance. There is a balance between training local workers or potential workers, and also getting the right balance in terms of importing those skills where we're getting mismatches here locally. So a bit of both, but yeah, certainly more migration will ease some of these wage pressures.
So I was just having a look this week at the futures about where the money markets believe the cash rate will peak, that 3-month interbank rate. Now, it says basically the cash rate could peak out around 3.5%, which where it is at 1.35% means we're not even halfway through the rate rising cycle yet, if they're right. Most economists have got the cash rate peaking around 2.5%. What's your own view on that?
Yeah, I'm a little bit in between those two numbers, Ross. I think we're going to go up to about 3%, potentially a little bit above 3%. That's going to take policy into outright contractionary territory. I think that's going to be enough. It does mean we're going to see a much weaker economy, I think, next year than we're seeing this year. But a little bit over 3% is where I'm calling the terminal rate here. And
was it important because we saw New Zealand, in raising rates this week to that 2.5%, it actually deliberately said we have now got contractionary monetary policy. We are deliberately trying to cool down our economy, cool down spending. You sense that's where ultimately the Reserve Bank will have to go if it is to kill off this inflation?
Yeah, pretty much. That's exactly right, Ross. And indeed, looking at the New Zealanders, they started their hiking cycle 10 months ago. It is the most mature and the deepest hiking cycle we've seen of any G10 country. So it will be very interesting to watch how the New Zealand economy goes. I think we can draw lessons, certainly for Australia, but also potentially for other countries in terms of how high rates are going to need to go.
It's really interesting this week. We've been observing that the price of oil, which is down 33% from its peak, the price of timber, the price of copper, are all well down from their peaks this year. Those things are deflationary, taking pressure off prices. But I get the sense that central banks around the world right now are genuinely worried about the fact that wages inflation, for example, we're talking about that gets into an economy and it's much harder to get out. And that's the reason why the central banks are prepared to keep rising, even though there's evidence of cooling prices in some areas.
Yeah. That's exactly right. Look, you look around that kind of supply side story, those supply side inflationary pressures, and key commodity prices have all come off. The only exception is gas. Everything else has come off the recent peak. So that's really encouraging. The problem is that supply side inflation story has now manifested into a demand side story. And as you say, much more difficult to get out of the system once it's in there.
Well, Phil O'Donoghue from Deutsche Bank, many thanks for your time today.
That's right.